So my assignment is to introduce the questions that we might be asking in light of the September repo market disruption that Trish and Jerome have just discussed. In the prepared remarks, I try to level set a bit by identifying three sets of potentially relevant changes that should inform the discussion of those issues. Trish already gave a terrific little précis of the first, which is the change in Fed monetary policy mechanisms and the fact that the Fed has now found out a little bit more about where the kink in the demand curve is, and that played an important role in the September disruption. The second change is, again, Trish alluded to it, the changes in the last couple of years in the Treasury market. With the budget deficit having increased by about 50% in the last 2 years, the supply of new treasuries that need to be absorbed by debt markets has grown enormously. Another thing that's happened, and Jerome was alluding to this just a moment ago, is that the marginal purchaser of the increased supply of treasuries has changed. Until the last couple of years, the Fed was the marginal purchaser of treasuries, right? The bonds under QE. And prior to the 2017 tax changes, U.S. multinationals with large offshore cash holdings were also significant purchasers of treasuries. Today, though, the marginal purchaser, at least, is probably a primary dealer and not maybe one of the biggest primary dealers. And this shift means that those purchases are going to need to be financed, at least until end investors acquire the treasuries, and maybe longer. So it's not surprising that the volume of Treasury-backed repo transactions has increased substantially in the last year and a half. You put all of this together, and it seems reasonably clear that digesting the increased supply of treasuries is going to be a continuing challenge with potential ramifications both for the Fed balance sheet and for regulatory policies. So the third area where the existence or non-existence of change is obviously relevant is in prudential regulation. It's not clear how much of high significance for repo has changed in the last couple of years, but as I think everybody in this room knows, to the degree there have been changes in regulation over the last couple of years, it's been deregulation. Now, whether existing regulations work differently because of the first two set of changes is probably one of the things that people want to take into account. So now turning to my actual assignment, what are the issues raised? I'm going to start with the Fed balance sheet policies, which obviously do relate to monetary policy. Most immediately, will there be another reserve shortage and price spike at the end of the year? The Fed will be only partway through its renewed purchase program, and end-of-year balance sheet window dressing by some banks may further constrict their capacity or willingness to increase their repo market activity. So are the ingredients there for a problem? Yes, it appears as though they may be. Now, I presume that the Fed is just as focused on this possibility as markets are, and that it's going to be prepared to augment reserves as needed toward the end of this month, but we'll see. The more interesting issue is what recent experience implies for balance sheet policies over the longer term. And addressing that issue, I think at least, involves answering two related questions. The first is what is or should be the Fed's tolerance for volatility in Treasury-backed repo markets. You heard both Trish and Jerome refer to the fact that if we haven't been quite vol-free over the last 8 or 9 years, we've been very much vol-suppressed, not just in the repo market, but in a lot of other markets as well. The second question is, given whatever risk tolerance volatility tolerance the Fed does have, what specific balance sheet policies should it adopt? So first, in the October 11th statement regarding monetary policy implementation, the Fed reaffirmed its commitment to an ample reserve monetary policy regime that operates primarily through setting administered interest on excess reserve and reverse repo rates, and does not require the active management of the supply of reserves. The Fed identified the risk it's concerned with as avoiding money market pressures that could adversely affect policy implementation. This is intuitive, right? This is what the guys in monetary affairs are going to work. Anything that's happening that makes it harder to transmit the FOMC decisions every 6 or 7 weeks. The question I have, though, and the question I think is worth discussing, is whether the Fed understands adverse effects on policy implementation to be more or less synonymous with any spike in repo prices. As Trish said, the pre-crisis scarce reserve monetary policy regime predictably experienced transitory spikes. Is there something about the current policy regime that would make similar spikes more of a risk to effective monetary policy implementation? Relatedly, is there reason to believe that it will be more difficult to distinguish transitory from persistent reserve shortages? And thus, is it desirable for reserve levels to be large enough that they stay comfortably on the flat part of that demand curve? On the other side, though, are there advantages to tolerating some measure of volatility in this market and indeed in other financial markets? Such tolerance would obviously permit a somewhat smaller Fed balance sheet, which the Fed might favor for a variety of reasons. But there's also that broader issue of whether policies that largely suppress volatility in normal times may yield more intense volatility when a significant shock occurs. So that's the first question. What should the volatility appetite be? The second question is, given that, what the balance sheet policies that the Fed should adopt? Again, in the October statement, the Fed noted its intention to continue balance sheet growth as non-reserve liabilities grow. So that's currency, for example. That means that you maintain the reserves at about the level that prevailed in the early part of September. The question to ask is this intended size for a buffer adequate? And the answer to that must in part depend on whether the Fed is now reasonably confident in predicting the effective capacity of banks to respond to spikes in demand for repo. It's pretty clear that pre-September assumptions were not wholly accurate, and there's a variety of factors that may have been at work here. Many have identified regulatory constraints as the culprit, and I'll say more on that in a moment. Others have suggested that the apparent additional reserves of banks may not translate into actual additional repo activity during spikes. Banks have different strategies for holding reserves versus treasuries, some which are at least indirectly driven by regulation, some which are just internally developed. It may also be the case that the internal risk and other limits established by some banks for their treasuries function have not been designed to take advantage of short-term price spikes. There wasn't the incentive to put in place a mechanism for having an exception to your normal limit. A key decision for the Fed will be the means by which it makes additional reserves available given its volatility tolerance and its assumptions about effective bank capacity. I think the most risk-averse approach would probably be to grow the permanent balance sheet enough to maintain a truly sizable buffer of reserves beyond what will probably be a shifting and somewhat uncertain point at which the slope of the demand curve steepens. This, though, would be closer to an abundant or really abundant reserve policy than an ample one. And of course, all the considerations that have been discussed for years in debates on the right size of the balance sheet will be relevant here. If there's discomfort with the prospect of a larger and possibly quickly growing balance sheet, the Fed might opt for some kind of backup mechanism to deal with surges in repo demand. One possibility is obviously the much-discussed standing repo facility. In his last press conference, Chair Powell hinted that there might be some way to facilitate bank use of intraday overdrafts in their Fed account. Now, either of these or a different kind of facility could presumably be priced to respond to anything more than a hiccup in demand for reserves, if that's what the Fed wanted to do, or not to click in until there was some moderate amount of volatility, and thus not allow some volatility before you start to pump in the liquidity. There's an additional question, which is a little bit orthogonal to what we've been talking about so far. Zoltan Pozsar has written on this several times, and that relates to the impact of the Fed's foreign repo pool in taking up balance sheet space. This is a long-standing facility, but in the last 5 years, since the Fed lifted the caps on its use, it's at least tripled in size. To the degree that foreign official institutions were or are selling treasuries to invest in the pool, the already growing market supply of treasuries will be further increased. And in any case, the pool is going to create another non-reserve liability. All right, now to regulation. So let me begin with two introductory points before I get to the questions. First, as I alluded to a minute ago, the various regulations that various people have blamed for the price spike were in place for at least several years before September. Yet until a few months ago, while there were a few hints of possible problems as the Fed began to reduce its balance sheet, there hadn't been any repo disruptions. So to the degree that one feels the need to rethink the regulatory framework, it must be because of the interaction of that framework with some of the developments that people have already chronicled. My second introductory point is that for both heuristic and policy purposes, it may be useful to distinguish between regulatory requirements directed at the size of banks' balance sheets, read capital there, and those directed at the composition of assets on those balance sheets, broadly speaking, read liquidity there. Beginning with balance sheet size, notwithstanding some of the instant commentary that suggested that the enhanced supplemental leverage ratio and or the GSIB surcharge bore responsibility for the September price spike, the evidence that I at least have seen to date seems fairly thin. The largest banks all had room within their leverage ratio requirements to increase lending, although this might not always be the case. And in any case, for purposes of the quarterly reporting of leverage ratios, the asset component of the denominator is based on the median size of the balance sheet over each day of the quarter. So a truly temporary increase to take advantage of the price spike could have been smoothed out in the remainder of the quarter. Now, with respect to the GSIB surcharge, it is indeed the case that the formula for determining the surcharge bucket into which a bank falls, it does take into account the amount of repo financing undertaken by the bank. And it is true that the repo amount is measured at the end of each quarter, not just at the end of the year. So you can see that there might have been the motivation to take the repo component of the GSIB surcharge formula into account even in Q3. But the impact of that is fairly attenuated. A pretty big decrease in repo financing will not shave that many points off the surcharge score. And as various market analysts have noted in the intervening few months, in past years, banks have made more adjustments in other balance sheet items where the bang for the adjustment, as it were, is greater. But if a bank is close to the cutoff between brackets, every little bit of regulatory arbitrage may help, and thus there may well be some incentive there. I think the GSIB surcharge issue raises several questions. First, would it really make sense to reduce capital requirements for the very largest, most systemically important banks just so that they can ramp up their repo activity? The musing by some observers that the September price spike was significantly accounted for by JP Morgan staying on the sidelines arguably reinforces rather than undermines the case for a higher capital surcharge. A key motivation for the post-crisis reforms was to take account of the systemic importance of institutions whose weakness or failure could disrupt the whole financial system. This is especially important in the case of runnable short-term funding. Reducing capital requirements to facilitate a private bank becoming a quasi-lender of last resort would seem to pervert the very aim of requiring extra resiliency as the systemic footprint of the bank grows. Second, might it not be better regulatory policy to calculate most metrics for the surcharge formula, including repo activity, based on averages over the course of the preceding year rather than on a point-in-time or a 4-points-in-time basis? This would both accommodate temporary increases in some bank activity, even at the end of the year, because you'd be working with an average from the preceding 360 days, while precluding the window dressing exercise by which a bank that is engaged in higher levels of that activity over the course of the year artificially slims down for a quarterly or annual snapshot of its balance sheet. Third, the window dressing exercise that can involve year-end reductions in repo activity does reflect the cliff effect disadvantage of the bucket approach to surcharges as adopted by the Financial Stability Board following the financial crisis. That is, for those of you who aren't familiar with this, the formula produces a score for the bank, for the systemically important bank, but those scores are then put into several distinct buckets. So banks with somewhat different scores can be in the same bucket, and a small difference in score can mean a 50 basis point increase in your surcharge. Within the Fed, at least, this is back when we were thinking of the post-crisis regulatory regime. Within the Fed, we were thinking tentatively about more of a continuous function approach, by which a bank's systemic score would correlate directly with the resulting surcharge rather than be in one of these cliff effect bucket circumstances. A change of this sort, like the previously mentioned idea of using averages rather than point-in-time measures, could be effected in a way that would be relatively capital neutral, though it would probably take more technical work than the data issue. Now, the issues raised by the repo disruption with respect to regulations affecting the composition of bank balance sheets are, for me at least, more difficult. As nearly everyone immediately recognized, the liquidity coverage ratio was essentially irrelevant in September, since treasuries and central bank reserves are treated identically. But they're not treated as fungible in resolution planning, and what I'm about to say is a contested point as to it's contested within my own mind. I don't know what the answer is here, because both some bank executives and yesterday Vice Chair Quarles seem to indicate that they were not treated as fungible in meeting the CLAR liquidity stress tests. That was not my recollection of the way liquidity stress testing was done, but I just don't know enough about how it's being done now, so maybe there is some such effect. I know there is, though, in the resolution planning context. Now, the specific requirements under both these frameworks are not published, so it's hard to draw any conclusions as to how binding these requirements may be. But during JP Morgan's Q3 earnings call in October, Jamie Dimon identified these requirements as the constraint that prevented JP Morgan from doing more repo, and said his bank is required to maintain at least $60 billion in intraday reserves at the Fed. Although one would expect that JP Morgan's size and complexity would mean that its requirement is considerably higher than that of other banks, even some rough back-of-the-envelope calculations would suggest that the aggregate requirement for all banks could be quite significant. Now, why would supervisors discriminate between treasuries and reserves? As a creditworthiness matter, we hope, there's not much difference between reserves and treasuries, but treasuries do need to be monetized. And in stress circumstances, when liquidity providers generally become more cautious, even as borrowers need more funding, monetization through other market actors may not be immediately possible. So if the aim of resolution planning and liquidity requirements more generally is to assure funding self-sufficiency by banks under all circumstances, there will be a preference for reserves. So long as reserves have been plentiful, this preference was a feasible regulatory choice. If they prove not to be, though, the requirements might contribute to the kind of episode that has motivated this conference. Given the pace of increase in the supply of treasuries created by the post-2017 budget deficits, the importance of the asymmetric treatment of treasuries and reserves may become more significant. And I do think that's a regulatory issue that's worth revisiting. Again, with the problem that for those of us outside the Fed, we don't have the numbers, we just have a kind of conceptual framework. Now, as always, one must caution that the mere fact that a regulatory requirement contributes to reduced lending or some other financial outcome does not clinch the argument for changing the regulation. That depends on the seriousness of the effect, as well as the relative availability of alternative means both to address the effect and to achieve the financial stability aims that motivated the regulation in the first place. But as I say, it seemed to me that Jamie had a very plausible account of what part of regulation might actually be playing a role, And that one, I think at least, is worth talking about, in part because of my closing remark here, which is to suggest an even broader regulatory issue that I think was implicated by the repo episode, although you wouldn't need to tackle this big issue in order to deal with the repo episode. The post-crisis approach to liquidity regulation, and here the liquidity coverage ratio is relevant, requires banks to amass large quantities of liquid assets to ensure their self-sufficiency during periods of stress. I have for some time been concerned that while this approach does a reasonable job of countering what Jean Tirole called the underhoarding of liquidity by banks during normal times, it may exacerbate the problem of banks overhoarding liquidity during stress periods, and it does little, if anything, to address the use of runnable funding by shadow banks. Having every regulated bank completely self-insure its liquidity needs, even under severe stress or failure, may make sense as a microprudential matter. You can see the logic of it. But if every bank must sit on its pool of readily usable liquidity in anticipation of possible failure, the result could, in periods of stress, be a decidedly suboptimal macroprudential policy that starves an already strained financial system of needed liquidity. Questions about the theoretical foundations for the current approach to liquidity regulation have been further complicated by the torrent of new Treasury issuance and the reduction in the size of the Fed's balance sheet. Now, it's neither realistic nor, I think, desirable to delay decisions on the more immediate issues surrounding Fed balance sheet policies. Devising a different approach to liquidity regulation, maybe one that centers more on sustainable funding practices rather than pools of liquidity, would take time, especially since any significant change would need to be internationally coordinated. And if an element of a different approach were to include more or less assured liquidity assistance, such as a Fed facility that would stand ready to monetize treasuries or other assets, the possible resulting increase in moral hazard would need to be addressed. But the disruption in repo markets, along with the recent reports of serious potential funding vulnerabilities among non-banks involved in mortgage lending, together remind us from two very different points that liquidity regulation remains an important, unfinished piece of post-crisis regulatory reform. Thank you.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.